Canadian bank stocks have been a pillar of slow and steady returns for millions of Canadians for several decades now. It's been Canada's most reliable sector, producing consistent earnings growth and dividend income for investors who do prefer dividend paying stocks with very little downside risk, as only two small regional banks in Canada have failed over the past century. It's a highly regulated sector that is currently facing some unique challenges, with lower economic growth expected to come in the near future due to the uncertainty regarding tariffs and also a highly indebted Canadian consumer, which was a pressing issue for the banks long before the tariffs came around. So, in this video, we're going to take an in depth look at the big six banks of Canada and try and understand the differences between them and also what factors are going to influence how they're likely to perform going forward. So, without further ado, let's just dive right in. The big six banks in Canada are RBC, TD, BMO, Scotiabank, CIBC, and National Bank. And of those six banks, the two largest ones, RBC and TD, are considered GSIBs, or Global Systemically Important Banks, and the other four are considered DSIBs, or Domestic Systemically Important Banks, which is a designation that's given by the Financial Stability Board. And the reason it exists is to address the moral hazard risk that exists in the world of banking, specifically with large banks, which is if they believe that they've become too big to fail and the government will just bail them out of their bad decisions, then they're more likely to take excessive risks to try and boost short term earnings, which is obviously a bad outcome for Canadian taxpayers if a bailout needs to happen for one of these banks. And it's also bad for the economy in general. So, this risk gets addressed by giving these banks these designations based on their size and ensuring they have to comply with certain capital requirements, which we'll dive more into this later. But what this is an example of how regulated Canada's banking sector is. It's described as oligopolistic and very actively regulated. Now, this is a double edged sword for investors because, on the one hand, you know that this market is essentially immune to disruption. These companies basically compete amongst themselves, and that's about it. There's not going to be very much change in the world of Canadian banking, which enables the existing Canadian banks to earn above average returns. For example, the return on equity for Canadian banks has been consistently higher versus the return on equity for other TSX companies for several years now. And the Canadian banking divisions of these banks specifically earn much higher return on equity than their US banking divisions, given the US market is far more competitive. And as we can see here, over the past 5 years, return on equity for US banks specifically has averaged around 10 to 12%, whereas for the Canadian banks, it's usually around 14 or 15%. And this has actually gone down in recent years because these banks have expanded their operations into the United States, which for them, it's a new growth opportunity. It's a new market that they can enter and they can try and win business in and compete in. But it's much more competitive, so it does reduce their ROE. And banks like TD, CIBC, BMO, and Scotiabank, they separately report their ROE for their Canadian banking operations. And as we can see, they are much higher, usually in the range of 20 to 30%. So much higher than the 10 to 12% you see with US banks. So, on one hand, this regulation has endowed the Canadian banks with a pretty sizable economic moat. The Canadian banking market, as we just saw, is highly profitable for them. But on the other hand, all this regulation does put a natural limit on how fast these banks can grow. I briefly mentioned capital requirements before, so now let's actually dive deeper into what these are and why they matter for the banks. The best way to think of capital requirements is they are basically rainy day funds that the banks set aside to absorb unexpected financial shocks, so like a market crash or a very steep economic downturn. And Canada's banking regulator, which is called OSFI, has been known to be much more conservative than most countries' banking regulators. The most common metric that investors look at is the CET1 ratio, or Common Equity Tier 1 ratio. And this is the most stringent requirement that is designed to absorb losses immediately as they occur. And this metric is a big reason why Canada's financial sector has been so stable over the years. The minimum CET1 ratio a Canadian bank can have is currently 11.5%, which is made up of the 8% base requirement and then a 3.5% domestic stability buffer, which brings it to 11.5%. It was actually previously just 11%, but then OSFI raised it by 0.5% back in 2023 citing reasons like high household and corporate debt levels, the rising cost of debt, and the increased global uncertainty around fiscal and monetary policy. Now, how it's calculated is by dividing the bank's common equity tier 1 by their risk weighted assets. And common equity tier 1 includes things like common stock, retained earnings, and AOCI. So, a lot of things that you see in the equity portion of their balance sheet, just certain accounts on it. And risk weighted assets are the bank's assets. So, loans they've given out to individuals and businesses with a risk weighting assigned to them based on how risky the loan is. So, something that is more risky, like, say, subprime lending, would have a higher weighting associated with it, say 80%, versus lending money to the government would be much lower. So, this ratio is a regulatory imposed limit to the growth of the Canadian banks. Now, the best way to explain why this works and why this actually limits their growth and makes things better for Canadians overall is with an example. Let's say that CIBC, who currently has $342 billion of risk weighted assets and a 13.5% CET1 ratio, they wanted to write a $100 billion loan to Elon Musk. This would obviously be big business for CIBC because they'd earn massive amounts of interest income from this. Even if doing this would probably anger a lot of people, but for CIBC, it'd be a big deal for them. But it would also be a pretty risky loan since Elon Musk could go and make bad decisions with this money, and there's a chance he may not be able to pay it back. So let's assume it gets assigned a risk weighting of 100%. So this would increase CIBC's risk-weighted assets to 442 billion, which would put their set 1 ratio at 10.4%, which is out of compliance with the minimum 11.5% requirement. So they would have to decline this deal unless they also increase their tier 1 capital, which they could do by issuing common stock, for example. But if they didn't do that, they'd probably get fined pretty heavily by OSFI for doing this deal with Elon Musk. So this example is designed to highlight how we have to view banks from a different lens than we do with other non-financial companies, which don't have these regulatory imposed limits on their ability to grow their revenue and grow their earnings. Now, the most important expense item that you're going to see on a bank's income statement are their loan loss provisions. And this is the one that fluctuates the most quarter to quarter and has the biggest influence on how much in EPS they end up reporting. So, loan loss provisions are money the bank set aside to cover future expected loan losses when their creditors can't pay them back. And the allowance for credit losses amount that you see on their balance sheet is the total amount that they have set aside for future losses of this nature. And provision for credit losses is the amount by which that has either increased or decreased over a given period. And that's on the income statement. So this is an estimate that gets made based on economic modeling done by the bank and takes into account things like unemployment rates, GDP growth, inflation, and many, many other variables. Now, this number is going to increase when the economy gets worse because businesses will be earning less money, so more of them won't be able to make their loan payments. Unemployment goes up, so more people default on their mortgage payments or on their credit card loans. And this number being higher means lower net income. And it also means lower loan growth going forward because really you need a thriving economy for a bank to consistently grow their loan portfolio and continue to earn more interest income from those loans. So, loan loss provisions are probably going to be higher in the bank's next earnings releases because their Q1 numbers either assumed tariffs wouldn't happen or that there was uncertainty regarding them, which we now know not to be the case. The tariffs are in effect, and by all common sense measures, they will cause a recession in Canada. So, really, the best way to think about banks is that they're performing this risk balancing act where their goal is obviously to maximize revenue, maximize profits. And to do that, they have to keep growing their loan portfolios. They have to find new individuals or new businesses to give loans to so that they can continue to earn interest income. But they can't loosen their credit standards in order to do so because doing that would lead to more of their customers defaulting on their loans, which would lead to losses and would hurt earnings over the long term. What's really important is an increasing supply of credit worthy customers that the bank can lend to. And for that, you need a thriving economy, which is ultimately what you're investing in when you invest in the Canadian banks. When the Canadian economy does well, so will the banks. Now, these banks also have other businesses aside from just their lending operations. They also have insurance, wealth management, and capital markets businesses. And these usually make up roughly half of the bank's revenue. So a good chunk of their revenue actually comes from these non lending sources. But the business as a whole is still very much tied to the Canadian economy. So let's look at how the banks have performed over the past decade and also what specifically caused that growth. Because once we understand what caused the banks to grow in the past. It gives us a better idea of what to expect from them going forward. What factors can we look at to understand how well the banks will perform going forward? So, what I'm showing here are total returns. So, both capital gains and dividends, and assuming those dividends get reinvested. The best performing stock was actually NBC, which returned 16% annualized over the past 10 years, but pretty comparable performance overall. Both are in that 10% plus per year range. And then I also included data that shows their annual growth in net income, in book value, and also the percentage change in their PE multiple, which tells us how much of that total return came from just an expansion of their PE multiple. And as we can see, NBC was the highest across the board. They had the highest net income growth, the highest book value growth, and all the banks saw their PE multiples expand over the past 10 years. And the reason for National Bank's success was that they gained a lot of market share in Quebec specifically, which has been their focus for a while, and also because they were pretty small to begin with. So this is good performance overall, but they did perform better in past decades. From 1990 to 2010, so a 20-year period, the banks produced an average return of about 14%, which over 20 years is very strong, especially considering how little risk there is with investing in these companies. Now, an essay that was published in 2011 by Hamilton ETFs made the case that the Canadian bank's performance over that time was driven by number one, lower corporate tax rates, number two, a highly favorable macro environment, which benefited from lower interest rates and a large surge in real estate prices, and three, a key change in the regulatory environment, which allowed the banks to acquire broker dealers, which helped them remove competition and create economies of scale, and also allowed for better cross selling opportunities with the different services that the banks offered. So basically, they went from just banks to these massive and diversified financial services providers. The essay also made the case that this was due to change going forward, since they've already reaped the rewards from those key factors. Their performance will likely be worse in the next coming decades. And as we can see, they were somewhat right. The bank's performance was worse, but it was still pretty good overall. And the reason this happened was mainly because the macro environment in Canada remained very favorable with near zero interest rates, which boosted their loan growth because that encouraged more lending to take place. Real estate prices continued to climb even higher, despite people declaring it's been a bubble for several years now. And most importantly, the bank started expanding internationally, which was a whole new avenue of growth for them that didn't really take off until about 10 years ago. BMO and TD specifically grew in the US, and Scotiabank grew significantly in Latin America. But it does seem now that we're at a crossroads where the Canadian consumer is highly indebted. The household debt to income ratio has expanded massively since 1990. So Canadians are over leveraged, and economic growth in Canada has been poor for a long time now. Real GDP per capita has barely grown at all over the past decade. So, for the banks to continue to grow going forward, they're probably going to have to tap into international markets more, which, as we've already established, aren't as profitable for them as the Canadian market is because international markets are much more competitive. And what's really become relevant recently, as I'm sure we all know, is that stocks in general have been hammered over the past few days due to fears of the trade war causing global economic growth to slow down. Now, this is a very fluid situation, and we don't know how long the tariffs will last, how bad they will be. It could be a few months, it could even be a few years. So, I'm not going to place too much of a focus on this right now, but we will at least assume that tariffs slow down economic growth in Canada in the short term. So, with all that in mind, let's now try and project what the future returns will be for each of the big six Canadian banks. So, basically, I have this Excel file here where I've compiled 10 years of financial data on all six of the Canadian banks. And I've put together a projection of what we think their returns are going to look like over the next 5 years for each of the big six Canadian banks. Now, if you'd like to access this Excel file, I've put it on my Discord server, which is free to join, and the link is in the description. So feel free to join that if you'd like to play around with this more and maybe make some adjustments to it. But what I'm going to do is walk you through one example of what I did. I'm not going to go through each one of the big six. If you want to look at one more in depth, then again, you can just access the file. But I'm going to go through one example just to explain my methodology and why I use this approach. And then I'll show you what the final results were. So, what returns, in my opinion, are going to look like for each of the big six banks going forward. Now, this is obviously a projection, it's going to end up being wrong. But what I want to show you here is a reliable way, something that you can look at to understand how to project the returns for these companies, right? What factors influence the returns and what personally I would look at. So here is RBC. We'll use RBC as an example. So the historical data is right here, and I have 10 years. So I have the book value, the rate at which book value has grown, and then the 10-year average, the 5-year average, and then net income, so the rate at which net income has grown, and then also return on equity, right? Which in a way is just net income divided by book value because book value is the same as equity. And then I've basically looked at what the averages are and then also looked at the PE multiples. So what was the 10-year average? What was the 5-year average? What is it currently? Trying to get a sense of well, what the multiples are for these companies. Because for the Canadian banks, the PE multiples are pretty stagnant. They don't really change that much. Obviously, they fluctuate a little bit, but I mean, as far as PE multiples go, they're pretty constant throughout the past 10 years. And then this is our projection here. So each of the fiscal year ends, and then we take book value based on a rate of book value growth. Now, for pretty much all of the examples I did, I assume that for the next 2 years, it's going to be pretty low. And especially for 2025, it's going to be low due to things like tariffs, macroeconomic uncertainty, various factors. It's going to be harder to grow your book value, get new loans, win new business when things like that are going on and, people are worried about a recession and whatnot. And then we basically take a projected return on equity. So we get book value, multiply it by the return on equity, which gives us net income. We then divide that by shares outstanding, which gives us a projected EPS for each of the years. So then we just go through each of the years and then we say, okay, by fiscal year end, which is October for the banks of 2030, they will likely have EPS around this range. So for RBC, we could say it's roughly $19 per share. And then we apply a high and a low PE multiple to that, which is really just based on historical averages. So the high is 12x and the low is 10x here. And then we take the current stock price, which is 157 Canadian. All of this is in Canadian dollars for RBC. And then we take the PE multiple multiplied by our projected EPS, which gives us the future stock price under the high and low scenarios. We add the dividend yield because this doesn't account for dividends, right? We're just looking at capital gains here because we're projecting a future stock price, but there's also dividends paid along the way. So you add the dividends. And then that gives us a 5-year annualized return. So really, it's pretty standard for RBC. 10.5% is what I would reasonably expect for them in the high scenario, and in the low scenario, it is 7.5%. And then I went and did that exact same thing for all 6 of the banks. We can see I have TD here, BMO, CIBC, Scotiabank, NBC, and I did include this notes section, which added some logic behind my analysis and why I picked certain rates of growth in or certain return on equity levels and then certain rates of growth in book value. It's pretty standard across all of them. Like I'm assuming it's going to be lower in the next year and then also lower in 2026. And then it picks back up in the future years, assuming the recession happens lasts about 2 years, which is obviously a big assumption. And then return on equity is roughly equal to what it's been over the past 5 years. But overall, here are the results. So this column here shows the expected annual return. And as you can see, I have BMO being the best. And a big reason for this is their expansion into the US, which doesn't include an asset cap like TD, which is the other bank that is really expanding into the US. But obviously, with things like anti-money laundering scandal that happened with them, which was a big issue for them, and that's kind of why their net income has been pretty poor over the past 1 or so years. But yeah, those are my thoughts overall. Obviously, it's a projection. It's going to end up being wrong. But what this does do is it gives us a method to follow and how to make more informed decisions when we're thinking about these banks. And this is the method that I use, right? Because return on equity, the rates of book value growth are pretty important metrics with the banks. It really captures everything with them, right? Their profitability when it comes to ROE and how fast are they growing their asset portfolio with book value growth. So I will say that Canadian banks would be a great investment once the tariffs subside, which is obviously a big question. We don't know when that would be, but particularly ones like BMO, which is growing in the US, and National Bank, which has demonstrated their ability to execute their growth strategy in the Quebec region. And that does have a natural limit to it, right? Quebec isn't very big and they can only grow so much in there. But I'd imagine if they have a proven strategy to grow in Quebec, they could apply it somewhere else as well. But yeah, that does it for the video, so I hope you guys did enjoy it and you found it useful. If you did, then please leave a like, and if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.